Hello, University of Michigan alumni and friends. Welcome to our panel discussion, Industry 4.0 and the Sustainable Built Environment, Smart Infrastructure Finance. We're so pleased you're able to join us today. First, just a couple housekeeping announcements. Zoom auto captioning will be used throughout this morning's event. To view captions, please click on closed caption at the bottom right of your screen and then choose show subtitle. Please use the Q&A feature to ask questions. To use the Q&A feature, please type your question in the Q&A window during any time during the event. Finally, before I turn it over to him, I would also just like to introduce our moderator and speaker, University of Michigan Professor Peter Adrians. Dr. Adrians is a professor of environmental engineering, finance, and entrepreneurship at the University of Michigan, with appointments in civil and environmental engineering, the Ross School of Business, and the School for Environment and Sustainability. He directs the Center and Master of Engineering program in Smart Infrastructure Finance, focused on efficient financing mechanisms for public and private infrastructure systems, such as water, energy, waste, transportation, and mobility. The center is a co-founder of the university's FinTech Collaboratory with the FinTech Initiative in the Ross School of Business and the Center on Finance, Law, and Public Policy in the Ford School of Public Policy. With that, and without further delay, Professor Adrians, please start us off.
Hello, everyone. It's very exciting to host this panel here. We have a great set of speakers and panelists. A lot of questions around smart infrastructure finance and the new trends, the emerging trends in the industry. Mike Perry is Executive Vice President at Nuveen, which is TIAA company. Patrick Brett from Citi is going to talk more about the municipal debt market, the impact of data on municipal debt markets. And then Darren Wolfberg from Blockchain Triangle. But before we give the word to our panelists, I want to just sort of sketch the context, I guess, of what we're going to be talking about. I mean, smart infrastructure finance and smart infrastructure are sort of words that are being kicked around, both in the media as well as in the popular press. I mean, who hasn't heard of things like smart cities or connected vehicles, connected transportation, transactive energy grids, or smart metering for sustainable water delivery and treatment. So there's all sorts of activities going on right now. And as we integrate more and more of our smart metering and IoT in infrastructure systems, the financing models of these systems are likely to change as well, or will need to change to actually keep pace. And so the objective of this webinar is to explore where the state of the practice is in the context of new public-private partnerships, for example, or the application of use cases for tokenization and blockchain applications, or the use of data in machine learning for ESG and credit rating. So as we're looking at these various different potential applications, different financing mechanisms, we thought it was best to actually talk to the experts in the industry. And so I'm first going to hand the mic here to Mike Perry from Nuveen. And Mike, I'd like you to introduce yourself and also how your institution is thinking about the use of data in your various different financial instruments.
Great. Thanks, Peter, and good morning, good afternoon, and good evening, everyone. Nice to talk to everyone today. A little bit about Nuveen. You know, we are an asset manager. We manage a little over $1 trillion, really across virtually all securities, both public equity and fixed income, but importantly, infrastructure, farmland, real estate, private credit, and the like. You know, our big focus this year, which I think is sort of connected to the discussion today, is that, you know, really across 100% of the assets that we manage, we've been looking to build out our ESG data capabilities to really ensure that every portfolio manager analyst is leveraging that data in the investment process. We're have tons of conviction around the idea that these factors drive valuation. We know that they reduce risk, and they also drive alpha, particularly in a lot of the private asset space. As we look out into next year, we think with a more favorable political environment, a lot of the regulators are also creating certain targets around climate. We're seeing corporate goals around climate in the U.S. So we're very focused in getting in front of that and looking at how climate's impacting our entire $1 trillion portfolio. And maybe for more discussion today, one area that we've partnered very closely with the university is, we happen to be the largest active manager of municipal securities in the U.S. And part of what we've been doing is looking at the underlying ESG factors across tens of thousands of credits, and really thinking about how do the dimensions of those credits match up with the UN SDGs? How do we think about those factors in terms of looking at risk, looking at attractiveness to investors, and attractiveness to our own portfolios? So looking forward to the discussion.
Thanks so much, Mike. So let's take the discussion to Patrick. Patrick, can you provide a little overview on the activities in the use of data in infrastructure financing?
Sure, happy to. And thank you for having me, Peter. I'm looking forward to the discussion and looking forward to the Q&A. So I won't take too long here, but yeah, I do, as you said in the intro, I represent the municipal bond market, which is, it's in a lot of ways, it's an old market. It's over 200 years old here in the US. It's a $4 trillion market. There's a lot that hasn't changed, but there certainly are parts of the market that are already being influenced by some of the themes that that you research and write about, Peter. I mean, the market broadly is made up of kind of what we think of as general obligation bonds, which are sort of the sovereign full faith and credit bonds. And then we have other bonds that we call revenue bonds, which are backed by like specific streams of revenues. And it's within that, there's some bonds that are backed by sort of taxes like sales taxes and income taxes. And then there's another category under revenue bonds, which are these backed by like a specific project. And I think that's the part of the municipal market that really intersects the most with your work, Peter. And that's where we're starting to see some of the biggest changes. I think, to me, just to talk about sort of two different areas where the municipal market's being impacted by these themes. I think one would be transportation, another is sort of broadly this ESG theme, but transportation, I think, is probably being most impacted. You probably don't even think about it, but just a simple thing like your Easy Pass or electronic tolling, I mean, that's already flowing through to sort of toll revenue bonds, which are being issued for 30 or 40 years and being used to finance new roads. I mean, that's a little bit marginal because you're just sort of altering the method of collection of tolls. It's a little bit more efficient. But when you think about that's enabling entirely new business models, like what we call hot lanes, which are lanes that you can move in and out of during rush hour and pay sort of by the mile for how long you use those. That wouldn't have existed before, but we're seeing those kinds of in Virginia and elsewhere. We're seeing that get done as well. So that's purely sensor based. You couldn't have done that previously. We do have, speaking of new models, there is a new highway bill that's coming up for, I think it comes up for reauthorization every 4 years or so in the US. That's the primary way that we finance infrastructure at the federal level. It's historically been financed by a tax on motor fuels, on gasoline. I don't know that it's going to change in time for this reauthorization, but I think it's very clear that we're going to start moving to more, instead of a per gallon tax on gas, we're going to be moving more towards usage-based taxes, which is really how we're going to grow the pool for financing infrastructure in this country and make it a lot more equitable. And frankly, gas consumption is going down because of electronic vehicles and things like that. So for electric vehicles, for a whole host of reasons, I think we're going to be transitioning over to more of that kind of usage-based model. Speaking of usage-based models, in the city behind me in New York City, we already have started to dip our toe in the water with congestion pricing. Again, obviously there's cities like London that have been doing this for some time, so that's not new technology, but it's just starting to get applied and starting to use for financing models. We already on rideshare, there's already a tax if you're in sort of certain geographic areas, which is of course, they use GPS to do that. Those taxes are going then directly into the New York MTAR subway system. So those are already being borrowed against to finance those capital projects. But once all vehicular traffic coming into the core of Manhattan is being tracked that way, then there'll be a much larger pool of money that a lot of it will be used for the New York MTA and to improve mass transportation. So there's kind of a virtuous cycle there. Just the last thing on transportation briefly. I mean, I already see it. I already see sensors and sensor data like cell phone data being used for the business cases for transportation projects. So if you think of if you're thinking of building a new rail line or something between two cities, like a high-speed rail, in order to build the business case, you need to know how many trips are going on between those places, how far the people live from the stations, things like that. And we can already do that much better now than we could even a few years ago by using the cell phone data. Just briefly on the ESG theme, you mentioned machine learning, Peter, in your opening. I think that those kinds of techniques, I think, lend themselves especially well to the municipal market. We already see them being used at Citi we're already using it in the equity market, for example. There's already machine learning and natural language processing that's used to kind of create ESG scores for different corporations. But I think as useful as that is in the corporate market, I think in the municipal market, we have 50,000 different issuers and 1.6 million different securities. It's just impossible for a human being to kind of go through and score, even historically, let alone sort of in a real-time basis as information is surfacing about all these various borrowers. So I think machine learning certainly lends itself to being used in the muni market. Very last thing in sort of that under that ESG theme, we are of course seeing in sort of alternative energy, we're seeing with smart meters and things like that with energy service contracts, we're seeing those meters and the data from them being used to sort of finance building efficiency investment in solar panels and new, more energy efficient building systems. But I think we'll get into more of the details probably in Q&A. So with that, I think I would hand it over to my fellow panelist, Darren Wolfberg.
Yeah, speaking of all the data and the energy markets that you talked about, the new fee-based projects and whatnot that you're referring to, Patrick and Mike. I mean, I think Darren is very well placed to expand on what Blockchain Triangle is doing in this space.
Thanks, Peter, and thanks everyone for joining from all over the world. So yeah, Blockchain Triangle is a young company. We're 2.5 years old. We have offices in Bermuda and New York. And really what we're focused on is really the intersection of smart meters and securitization. And, you know, what does that mean exactly? So if you think about a use case where you've got a solar farm and you've got a solar farm owner and you've got a smart meter between the solar farm and the utility, that's going to give off data to both the utility and the solar farm. And really what we do is we pull that data into the securitization of the asset. And with a power purchase agreement or an offtake agreement with other participants, we're able to realize and see the cash flows of that asset on a near real-time basis. And there are a lot of benefits to that by taking big data and securitization and putting it on one chassis. Some of those benefits are issuer costs come down, because when you look at an issuance, that issuer has to pay administration, reporting, and trustee services. So that's an ongoing cost every year over the life of the asset. You know, we can bring that down to the cost of software. When you look at an oil well is going to produce oil. That way the operator can see how much oil is produced on a real-time basis. And there are those tools that are out there today. But what is not out there today is, you know, someone like Mike at Nuveen, he's unable to see real-time what is the production of that asset. And are there more capital efficient ways in order to hedge that asset or hedge a pool of assets that are producing solar power? You know, when you think about transportation, you know, you have the easy pass, the toll road, a bridge that you go over. And what we're able to do is every car that goes through is pull in what is that cash flow information for that. We were recently brought into the UN's Climate Change Coalition, and you talk about a lot of the inefficiencies in the private market. And what we're able to do is really provide a lot of those efficiencies back to these asset managers that will not only get a more efficient mechanism to subscribe to an offering and have an investment, but they also will be able to see real time the performance of those assets. And that's really exciting. You know, in the traditional asset world, we've seen for a number of years now how hedge funds and mutual funds and other large asset managers are pulling in information in order to extract that alpha and figure out where they need to be ahead of that next person. I don't think we're going to get to high frequency trading of infrastructure assets, but there is an efficiency gain to be had for asset managers and asset owners as they think about this. This data can also be used by insurance companies so that they can price risk better, and so insurance levels can come down. And then you have researchers who want to evaluate the impact of climate change. You know, we're really there to connect all those pieces together. And the only way you can do that is to get all that data through one pipe where the investors see it, where the issuers see it, where the researchers see it, and where the insurers see that. And to do that, you have to connect big data and securitization together. So with that, Peter, let me turn it back over to you. Thanks everyone again for your time, and look forward to the question and answer.
So it's a fantastic overview. I think we got a pretty granular view, I guess, from at least three dimensions here across our three panelists. And I think, Darren, to pick up on what you said, a lot of what data and smart infrastructure finance is all about is about making illiquid assets more liquid, right? So you get a lot more information, near real-time information. And this actually goes to one of the questions of the audience, who talks about, well, I mean, data and industry 4.0, again, are sort of very abstract concepts. They apply differently, whether it's to equities or to fixed income like the bond markets or private equity or whatnot. And sort of where do you see sort of the initial penetration, I guess, of a lot of these data first happening? Is it first going to be in the securitization market? Is it, I mean, it already, of course, is in public equities, but sort of where do we, what's the penetration scale right now in the fixed income products or the muni market? So I'd like to get your initial view on that.
Yeah, so I mean, I think the first place you're going to see this play out is really in the climate finance market. When you look at all of the government mandates that are in from all the different jurisdictions in the world, you're looking at about $2.5 trillion that needs to get put into climate finance over the next 5 years. And that's kind of taking a lot of those goals, you know, by 2035 or 2030 or 2040, whatever year you want to say that you want to be carbon neutral, and working backwards to how do you get there? In the next 5 years, $2.5 trillion needs to go into this segment. And really the challenge is that segment today is really an inefficient market. And the reason why it's inefficient, if you look at the big muni market or the big infrastructure market, the big players have to play at a certain size. And that size is, you know, $75 million, $100 million, you know, and because of that size, there's a cost for due diligence. By bringing it down to the smaller sizes where a lot of these climate finance projects will be, you're able to then bring down that cost of issuance, that cost of capital for all of those participants. So we think that's where the early adoption is going to be. It, you know, smart meters on a solar farm, smart meters on a wind farm, those are already there. We're starting to see the integration of digital twins, which is where you have an existing asset and you're creating a digital version of that asset. So we think that's where it'll come first. And really, we're working on building out those pipes so that as the business and the industry grows, we're there to provide the likes of Patrick and Mike those tools so that they can bring them to their clients.
If I could add, maybe Peter, one of the things that we're one of those investors that have the large holdings and buildings and the like. And for us, it'd be great to be able to fractionalize or create liquidity and de-risk those positions. It's sort of a similar type of issue. And what we're finding, I think the technology is there around, standardizing contracts and fractionalizing. One of the difficulties is that you still own an illiquid contract, even if it's smaller, right? And so there's a limited set of clients that could buy that. And then you have very immature markets. So, you're starting to see the evolution of exchanges that can take on those types of contracts so you can open up to a much larger pool of investor. But to me, it's the demand side that needs investment as well. Like we can carve it all up, but then to get it out even in smaller sizes, is tough because of the illiquid nature of the asset in the end.
Yeah, actually, you're bringing a point up that I hear a lot. Pension funds. I mean, you're a pension fund investor, Patrick. You're also custodian for pension funds within Citibank or within Citigroup. Only about 5 to 7% of pension fund capital is invested in infrastructure, and there are reasons for why it is. Do you think that the liquidity or the securitization opportunities that data offer might potentially bring more pension fund capital into infrastructure, or do you think that that's more of a long-term goal?
Yeah, I think it's a great question, Peter. I think absolutely it will. I mean, these pension funds are massive, so even changing asset allocations, Mike knows well. I mean, changing an asset allocation by 1%, especially when you're moving into less liquid markets, is a Herculean task. But yeah, I think absolutely. I mean, there is a wall of money that's trying to come into infrastructure. I think that thematically, the interest in it's grown more quickly than there are even sort of investable opportunities. So the demand is outstripping the supply. But yeah, I think absolutely some of these techniques that we're talking about, I think will help increase the supply. It'll help give investors confidence to invest kind of over that 30 or 40 year horizon, which is really what pension funds are looking for. I mentioned in my opening comments that even for something like a new high-speed rail line or something, I mean, in the past, it would have been very difficult to get your head around that risk, certainly over the long term. We know very well sort of trips between two cities from airplanes and things like that. It's all well tracked, but for something like road travel between two different cities, it's very hard to know. And to the extent you can use cell phone data and other sensor data to build a much better business case for it, you'll be able to create more of those projects. You'll be able to create more supply of the kinds of investments that pension funds are looking for.
And Peter, if I could just make one comment.
Sure.
You know, when you think about the mortgage-backed securities market, and I think it's a good parallel to how do you achieve scale. So mortgages, you have, very small slices of mortgages that make up a larger securitization. If you're able to pull in the smart meter data and you have the revenue profile of each asset. So if I have 10 $5 million assets, I've got the revenue data, I can create the securitization of that asset on a larger scale. So I think that's something that we may see from the MBS market make its way into the infrastructure market.
Another dimension of this, just to add on here, one that is more of an investment view. Rates are going to be low for long periods of time, and so infrastructure does provide yield in a non-correlated way. That's a very attractive thing. So you're going to see that's going to pull. I think also, there is, you want to manage the asset efficiently, but I think in the U.S. is coming along, but outside the U.S., people are directing, these investments towards areas that they think are the right thing to do with respect to climate change and the like. And I would imagine that the renewable space in the U.S. is only going to get larger for some of those same reasons. So there's non-financial reasons why I think you'll see more capital come into this space.
That's a perfect segue for one of the questions that came up through the transom, Mike, and that is, you were referring in your introductory comments how ESG data is starting to inform valuation of assets and whatnot. Can you expand a little bit more on that and how you see that happening, how data and ESG is changing valuation of infrastructure assets?
Well, Patrick mentioned earlier that there's just hundreds of thousands and tons of different credits in the municipal market, a lot of small issuance and the like. We've actually made a lot of progress. We're around 30,000 credits that we have actually scored. And the way to think about it, two lenses. One, it helps us assess the value of the security. But if you look at, call it school bonds, right, that fund local school districts, you're going to look at graduation rates, teacher to student ratios, and you'll come up with a score. Now, the score may not be good, or it could be positive. I think an investor may, one, it's going to give you clarity on what you own, but there may be investors that want to invest in the lower scoring school districts. So the allocation of capital is driven that way. Conversely, it might also, show you what the risk is when you look at the tax base and other factors of that school bond. So the more all these factors, I do think drive not just better information to assess the asset, but I think investors are going to be looking at those dimensions to direct where they want to invest. In fact, we're seeing clients customize their separate accounts. And now we are finally able to allow them to direct their investments in the municipal space, given the profile of these factors. It could be hospitals, you name it. There's all sorts of interesting ESG factors that inform the value of those bonds.
So you would argue that the ESG is really starting to mainstream, and actually that mainstream investors are going to start thinking about integrating that information into the decision-making process and allocation process.
Well, if you look at asset flows, across all markets, there's more than a doubling happening now, still off a smaller base. But my sense is in 2020, we've seen a real move across all different types of vehicles coming into ESG related flows. I think that's only going to accelerate here. It's taken a while, but it's starting to happen.
That's right. Darren, I want to pick up on a comment that you made earlier in your comments, and that also tees in very well with a question that came over the transom, and that is, can blockchain and tokenization and securitization, you argued, it is changing the cost of capital to finance infrastructure, and clearly, investors in developing countries and emerging economies and whatnot, they're very much looking at cheaper forms of capital. I mean, in the U.S. also, but I mean definitely in those countries as well that perhaps have poor credit or have less access, I guess, to a mature capital market. So where do you see the opportunity of maybe blockchain or tokenization playing a role there?
So I think, when you're looking at emerging economies, blockchain tokenization, I think there's the whole being able to access the crowd. That was something that we did see as a positive takeaway from the ICO craze, even though there were tons of bad issuances. The concept that an issuer can access a crowd was certainly something that I took away as a positive from that. Democratizing capital. When you're thinking about investors and emerging economies, poor credit, access to credit, that's certainly something that you're able to accomplish with that. I think one of the big things that there's always the fear of with emerging economies is corruption or any nefarious activity that could get its hands into that, or how many hands does your revenue go through before you actually see it. I think with taking smart meters and direct revenue streams and being able to carve out and move that capital once it processes into investor pockets allows investors to know that they have that security because they can get near real-time cash flows from those assets. Certainly there's operating costs and other factors that you need to account into that, but that takes one of those major risks that exist today and brings that down. Also, by getting all this information on the performance of the asset, you may find that there are many diamonds in the rough where you're getting massive throughput of output of the economic output of the asset. And that's really what investors want to find. They want to find where can they get the most productivity for their capital. And that's really what we're able to reflect because we're showing the real-time information, which we think does lower the cost of capital.
Right. So I wanted to direct a question, take that and bring it to Patrick, given your involvement in structuring public-private partnerships and whatnot in the muni market. One of the questions that has come up from the audience is, what are sort of the new types of public-private partnerships that you're seeing? And just by way of backdrop, I mean, we're in the era of COVID now, and COVID, as you all know, and there's been many reports, both the popular media and elsewhere, has really destroyed public budgets. And such that 700 cities in the US have said we're going to be either deferring or altogether, putting off any kind of new investment in upgrades of infrastructure. We need to look at new smart public-private partnerships, and it all sounds very good. But sort of from your perspective, Patrick, what are the new kinds of public-private partnerships that you guys are exploring, or that might even take advantage of? You were talking about fee structures and whatnot that might take advantage of data and help out, I guess, all our public agencies to help finance their infrastructure systems.
Sure. Yeah. I mean, I think you're absolutely right. Everyone's trying to figure out how to do more with less. And I think public-private partnerships are one of the ways, and even being able to do things better, frankly, from the start, better designed projects. But I think in the broadest possible sense, I think the municipal bond market as a whole is a kind of a public-private partnership, in the sense that most of the $4 trillion market is exempt from federal income taxes. So there's a subsidy that's being provided, and the borrowers are, except for the subsidy, the borrowers, the governments that are borrowing, are paying off all the debt themselves. And there's private investors that are coming in, like Mike and his firm, that are doing all the due diligence on the credit. And I think it's a very kind of simple foundational thing, but I think it's one of the things that's best about the municipal market. And one of the reasons why, I mean, I talk with a lot of foreign governments who are very interested to emulate the U.S. municipal market, because they really want that kind of market structure, frankly, with the private sector so intimately involved in the allocation of capital across all these infrastructure projects. But more to your question on public-private partnerships, I mean, I think there are, and people talk a lot about infrastructure banks. There are some models already that I think, as the Biden administration comes in and thinks about what to build new or what to expand upon, I think we do have some really great models for quasi infrastructure banks already in the U.S. In the U.S. Department of Transportation, we have something called the TIFIA program, which is a loan program from the U.S. Department of Transportation, which is meant to be used in conjunction with private capital. And conceptually, it's very easy to say that, but to actually design a program that effectively works alongside private capital, doesn't crowd out the private capital, but helps make possible projects that wouldn't have happened otherwise, it's very difficult to do. That program's been developed over decades, and I think I wouldn't be surprised at all to see the Biden administration expand upon something like that, as well, like in the area of affordable housing, where I think, especially in a lot of cities like the one behind me in San Francisco, we have a real affordable housing crisis. We have something called the low income housing tax credit program, which again is a very carefully designed program, which helps to marry up government capital with private. I mean, but I think, like, directly to your question on P3s, I mean, we have seen, we worked on the LaGuardia Airport Central Terminal here, which I think has been referred to as the third world airport by some of our leaders, which unfortunately was probably true. It's still being worked on, but some of the first parts of that have already been opened, and that was financed completely with a public-private partnership by LaGuardia Gateway Partners, and there were municipal bonds, which I think it's a matter of public record. I think Mike's firm is a pretty significant owner of that airport. So it's private capital coming in, and it's actually a private operator, which has leased, I think, for probably 40 years, the rights to operate that airport. And then, of course, they're coming at it with a different perspective, a different way of building it than maybe it would have been done by the private sector, a different way of amenitizing it, a different way of running all the retail than it might have been done.
I was going to say, so does that open up to new data monetization opportunities or whatnot?
Yeah, and yes, absolutely. I mean, and I think, yes, I mean, you could think, I think Darren would be the one to talk about sort of slicing up assets. Like in real estate, people are talking about using blockchain to slice up floors of office buildings. I mean, I don't know why you couldn't slice up gates of an airport or some of the, using blockchain and using some of those techniques. To me, that's more where you're going to see like blockchain being used. I think it's been talked about in municipals for kind of allowing like micro investments and things like that. And I think that's met with kind of limited success. I don't know that that's the first place we're going to see it. I think it's going to be more in sort of tokenizing the like big assets and maybe allowing investors to invest in specific parts of them that maybe have a risk and return profile that they want, rather than the entire thing at once.
Darren, did you want to chime in on that?
Yeah, no, I would say, when we think about assets, it's really any type of economic output that can be extracted from the asset and done with a smart meter or IoT is in theory an asset that can be securitized in this format. You probably have arrival data and departure data, which tells you how many planes are at the gates at any one time. And certainly there's a revenue that's associated with planes that are at the gates. Getting down to retail data as far as rent economics, that's harder to do because you're essentially taking that one pipe that has that revenue information, and now you're adding many different threads to it, which obviously increases the complexity of the offering. But I think for the base cases, when we think of an oil well, you got a smart meter that knows how many barrels you pumped today. When you think of a toll road, an easy pass, you know how much dollars are coming through that toll. So I think there's a lot of fertile ground to go after some of those one pipe streams, water desalination, bioethanol, run through the list. There's a lot of one stream data points that you could develop and securitize. And then I think that will catch up to some of those more intricate and complicated definitions. But ultimately, when you do a deal like that, there's an operator and he's there to make money. And you've got the investors in there to make money. And in between that is this spectrum of alpha and risk profile. And I think we're able to kind of squeeze those together.
Peter, I don't know, actually curious what Darren's thoughts on. One of our biggest challenges is all this data that's being created is not standard. It's very hard, even in more sort of liquid securities to clean it, understand it, and then use it. Whether it's the LaGuardia example or inclusive finance in less developed countries. The challenge is if you had the data, it would really help and make it easier in a consumable form to make investments and with more confidence. I'm curious your thoughts generally about how that final mile, right? It can be used for the operator, but how do you get that out to the public, so to speak, in a way that can be managed? Because I think that would unlock all sorts of new capabilities.
Yeah. And coming from the software side, the old adage is garbage in is garbage out. And I think really what we're trying to identify is, for an asset, what is that data output? What is that API feed that we need to connect into that is associated with a specific smart meter or specific IoT or a group of them that essentially pull into one file? I think some of this is you've got the smart meter world, which is not an immature world. And then you've got the securitization world, which is obviously not immature at all. And really, I think we're trying to operate at that center point. And it's really going to be a case-by-case basis and getting those, I call them nodes, but essentially getting those access points of information synced into a specific asset. Because once you sync that asset in, once you've got that smart meter data so that you have that one profile, that then begins to, because that's a clean stream in. Once that clean stream comes in and you can do that multiple times, you then be able to take that information and then pull in other tertiary information, which could be, well, how many visitors are going through LaGuardia? What is the cell phone data that's going through LaGuardia? What's the credit card sales of the participants that are in LaGuardia? And then you can actually run correlation and analysis, which is a second level deeper. But I think that's the progression of what you're going to see. But it really takes one smart meter at a time.
So standardization and benchmarking of all these data, and clearly a lot of cleaning up post-processing and whatnot is going to be key, which is of course a lot of what our center does. Back to you, Patrick. Question then is are banks going to become data asset managers and moving towards less direct ownership in assets? Do you think that is a trend?
That's interesting. in data in the sense, banks since time immemorial have been risk managers, right? We're in the risk management institution. We're taking in shorter term deposits and lending them long, and that to be able to do that, you have to be in the risk management business. So I guess in a certain sense, we've always been in the data business. I guess back in like Venice, it was probably more, you kind of knew the people that you were lending to, and you knew their business. But increasingly it is about data. It is about the information that we have. Interesting if we were to become more sort of purely in the data business. I think there is a space obviously for sort of regulated lending, if you think of like credit cards or other, I haven't spent a lot of time thinking about it, but I think there is probably still a space in society for that kind of lending. And of course, there is a use for data as an overlay. There are, of course, limits to, I mean, some of the data is almost too good. So you've seen areas where regulators have moved in and said, you can't use this level of granularity, especially in cases where there may be some kind of like an outcome that might disadvantage a certain group of people or something. If you were to go down to a really sort of micro geographic level, and we've had there's like specific rules against that. So some of the data has to be used at like a more aggregate level, so there aren't unintended consequences from it. But yeah, absolutely. I mean, we have teams of data scientists. I have some working with me now actually on the municipal market to get credit insights and things like, which is something that just wouldn't have happened a few years ago. So yeah, absolutely. We're in the risk business, therefore we're in the data business, and that's what we're going to be spending a lot of our time and capital on in the coming years.
And Mike, Nuveen launched Nuveen Labs last year to also sort of really amp up the whole data science side of the equation. Just wanted to bring up something that was mentioned earlier, and that came up through the questions as well. This relationship between credit rating and therefore cost of capital and ESG rating, and ESG rating becoming sort of a precursor for a credit rating potentially. So do you see, and as I said, it's a question that came up, I mean, is sustainability, I guess, however defined, we're going to become an opportunity to make projects more bankable because they become more attractive from a credit perspective?
I mean, in some of, I was doing some reading in preparation for this discussion, and I think the largest green bond issuance this year out of Germany, they came out with both call it a ESG version and a standard off the run version. The ESG traded tighter than the other bond, right? And so now that could just be a supply demand thing, or what we're finding, what's resonating with investors is that ESG equals less risk and safety, because you are looking at other dimensions of the security. So in my mind, I think you'll see, I don't think you'll see a kind of parallel sets of investments over time. You see a little bit of that now. It'll just become part of how you evaluate investments, and I do think it will. Again, those that have a better feel for those ESG dimensions, I think will have an edge in terms of understanding the true value of the underlying public or private asset.
Just to push a little deeper on the ESG side, where's your weighting between E, S, and G when you look at projects and you look at financeability of projects, or how you rate your bonds? You weigh the environmental and what Darren was talking about. I mean, sort of the first opportunity for data-driven finance, sort of more on the climate side. Do you link that into social? Do you link that into environment, or how do you button all that up? As in, what kind of data are you looking for?
I'll comment. I don't know if Patrick has a comment also, but we don't weight. It's not a weighting matter. It's just, I think some factors are more evolved than others. So G, for example, has been around for a long time. Investing in an equity and looking at the governance of a company. I mean, it just wasn't called G, right? It was just a normal due diligence on a security. So there's not a weighting. You're just trying to get the best information. Now, I do think there are investors out there that are trying to weight a certain view that they have. I still think, depending on where you are on the globe, that's a bigger driver. In the US, I think, is a late adopter there. I think there's less folks that are trying to drive a certain outcome or understand, the purpose of their investment. And then I think you would then weight one of those factors. On our end, we're trying to drive alpha and drive performance for our clients. So we're trying to use all the information that we can.
Yeah, and I would just say, I mean, I think it's difficult to invest in sort of along all three dimensions at the same time. So I think we see a lot of investors that are actually sort of looking at sort of one theme at a time, or even within one theme, kind of subsets of that. So you have investors that are investing based on sort of the EU's new taxonomy for investment around the UN Sustainable Development Goals, and are even within that trying to invest along particular goals. I think that's more doable, because you could have a company with kind of poor governance that's doing a project that has massive environmental benefits, or vice versa. So I don't know that you would be able to invest a portfolio if you were sort of trying to optimize around all three with each investment.
Right. Darren, do you see the ESG data getting loaded on the blockchain and being valued in blockchain transactions?
Sorry, repeat that again.
So do you see the ESG data sort of making their way also within blockchain transactions?
Yeah, no, I think that, you know, there's a couple different ways to think about blockchain. Are you using blockchain to memorialize a smart contract, or are you using blockchain as a data streaming mechanism and a data filtering mechanism? And I think the important thing is, you know, you mentioned the question about factor weighting between the different elements of ES and G. And I think, you know, the big asset managers may not be there today, but I can see a time where, based on the big data pipe input that we can have into their risk, along with the securities information and the price information, that they can then take that information and splice it up and run their own analysis of what element of ES and G are they going to get the most alpha from? Where is it the best credit rating return profile across that? And I think, you know, from our perspective, we'd love to work with Patrick and Mike and figure out what are those things that you want to consume, and we'll build that pipe so that you can consume it in the format that you want to consume it in. So I think that's kind of where we think, you know, blockchain kind of fits in. And you know, the data can be either an API feed, or it can be, you know, a distributed ledger format for that. I don't think it needs to be one or the other. I think the most important thing is your smart contract, which memorializes the relationship between the security holder and the investor. That framework allows that information to flow.
Yeah. And Peter, it might also be asset driven. Yeah, today it's, you know, for a building, you're getting sensors around energy efficiency, right? For a farm, you're getting sensors around water usage and flow across. Yeah. So I think, and it's much easier in the private asset space than the public securities, where there's a bigger disconnect between, you know, those factors in the valuation and the traded price of that security.
So I want to sort of move a little bit further away from a bit tied into the ESG, but sort of back to a social equity kind of question. I mean, some of the questions that come up is, okay, so you want to build out adaptive infrastructure, smart infrastructure. All three of you are arguing, oh, I mean, data is going to have a lot of value, whether it's ESG data or whether it is smart metering data, performance data, and whatnot. And here I'm talking to a couple of weeks ago to 150 public finance managers, many of whom are coming from rural communities. And they said, we do not have the same broadband infrastructure that your cities have, or that even your suburbs have. I mean, I know there's a lot of talk about sort of broadband equity. How do we even finance that? I mean, for Mike, Patrick, I mean, any of you, I mean, how do we even, you know, bring everybody up to speed there? I mean, it's not going to be the ISPs, because there's not enough value there in terms of contracts. I mean, of course, we can always argue it's going to be Starlink. I mean, I don't know what it's going to be Starlink, but what's going to be the build out, I guess, in the end, I guess, and how we can bring the rural communities kind of in the fold of the new economic opportunity and investment opportunity to upgrade their infrastructures.
I mean, I would say, just to start, I mean, it's not every infrastructure project that we do or is even worth doing that pays for itself. It's actually probably the exception in munis that we have projects that sort of fully pay for themselves. And in general, I mean, even the LaGuardia project I mentioned, I mean, it is a public-private partnership, but I think that the governor, for example, decided that they wanted to have like a sort of more dramatic entryway or something there. So the government's paying for that. But to your point on social equity, or I mean, think of mass transportation. I mean, there is a common good that comes from it, but there's no mass transportation system in the country. that pays for itself. So I think the same is true probably with rural broadband. I think we could decide as a country that we need to get it done. I think a lot of that's going to have to come. There are smart models for charging for it and for financing it that we could marry up with public subsidy, but I think we probably need pretty significant government grants to help make that possible. The same way we did with the postal service and I mean in the telephone system. We need to require public regulated private companies to do it as a cost of doing business, the same way banks are required for the Community Reinvestment Act to do a certain amount of sort of urban investment, also some rural investment. But we need to do that as sort of a cost of doing business in order to maintain our license. So it either has to be that kind of model or just a direct government grant, I would think.
Mike, clearly a very big S around that one, right? I mean, the social equity and broadband in rural communities.
There is, and I'm not about to purport that I know what the final answer is. I mean, maybe the same way fracking and new ways of creating oil has really driven a lot of economic development in certain parts of the country that didn't have that benefit. You might find renewables, for example. The U.S. does have the asset of a lot of land, and these rural areas are near that land. So maybe the renewables push is a way to help fund economic development, which in the end can help with the broadband needs that are out there. But it's a tough problem.
So any final comments that any of the three of you want to make around the opportunities for data in the smart infrastructure finance space? Where do you see the trends? Where are we 5 years from now, 10 years from now? Darren. Sorry.
I mean, I think you're going to see a lot of big data securitization really becoming more of the norm. And the reason for that, you already have precedent where asset managers are consuming data in order to make investment decisions. So that's there already. And you've got a mature securitization world. And I think, as opposed to me being the evangelist, I think there will be lots of evangelists out there that will see the value. Issuers will be able to manage their assets at a lower cost on an annual basis. Investors, most importantly, will get real-time information. I see a world where self-directed 401ks and self-directed IRAs, they're investing in a solar project that's going to give them an 8% return, or a wind project that's going to give them an 8% return, because that's a good return in this low interest rate environment. And the alternative is, are they going to pay a private equity firm 12%? So I think within that, there's a lot of opportunity for assets like this to really become mainstream and adapted. I'm really excited for it. We're looking forward to working with people like Patrick and Mike in the future, and really figuring out ways how we can solve problems.
Yes, provided we can standardize the data, right? So Mike, your comment on where are we 5 years from now?
Yeah, I think the broader ESG industry has been challenged around trying to explain what it is, right? Folks think it's about exclusion, and so underneath, I think, like anything else, the technology will rapidly advance. But I think where you'll see the real benefit is when we can you'll see more simple reporting, articulation of the information, so that the average investor can get their heads around what it really means. And to me, then you'll see a multiplying effect in terms of folks being more comfortable and insisting that these factors are part of the, not just what they're investing in, but how they report and understand what they own. So I think that's going to be a natural sort of next step here.
Great. Patrick.
Thank you. Yeah, I guess I'll end where I started, which I think in 5 years, I would certainly hope that we do start to see some of the more usage-based transportation, a highway trust fund that's funded more based on that than the old gas tax, which hasn't changed for 20 or 30 years. I think you'll also see, because of this data, I think you will see more private capital coming into infrastructure projects. I was mentioning before that example of sort of high-speed rail between two cities and being able to have a better business case. I didn't really complete the thought. What that gets you is the ability to get private capital in there. Because in the past, if you couldn't bound the risk you wouldn't be able to get private capital, and you had to have government capital come in because it was only government that would take those kinds of risks. But now that you can use the data that we have to kind of better define those risks, it's possible to pull in investors like Mike into those projects in a way that you couldn't before. And then last, I mentioned ESG and that scoring. I think in 5 years, we certainly will be in a place where municipal issuers and borrowers kind of across the capital markets are kind of much more frequently and it's easily scored kind of across all these dimensions using machine learning and natural language processing techniques that we talked about.
On those positive notes, I want to thank the three of you. You've covered a lot of ground here, from securitization to blockchain to looking at the ESG opportunities of valuation. And, you know, going back to these muni bonds, you said they were very old, right? I mean, in fact, wasn't the first muni bond issued about at the same time that the University of Michigan was founded, 1817? I believe it was around that time. So it's been a long time. So I think connecting that back to the U of M, I want to first off thank the three of you for a very exciting discussion. I want to turn the conversation back to Christine.
Thanks, Peter.
Thank you.
Thank you so much, Professor Adrians. That was an extraordinary session today. And also, I'd love to thank now our wonderful speakers, Patrick Brett, Mike Perry, and Darren Wolfberg. I certainly learned a lot and appreciate your taking the time for this discussion. I also want to thank our attendees. I'm so pleased that so many of you were able to participate, and for your thoughtful and insightful questions, and for staying with us until the end. So I'll say thank you one more time and leave you all with a warm "Go Blue."